Hey, so we are live. I've got Ari Ditkofsky of Dominion Lending, the top producers team. I've had the privilege of working with Ari, being Ari's client myself. I continue to rely upon Ari for his expertise and incredible knowledge within the mortgage field. Um, Ari, it is a pleasure to be here with you today.
Likewise, Lani, thanks for having me.
Of course. So why don't we just sort of dive in? Um, I've got clients talking to me all the time. Should I go fixed? Should I go variable? Where do you stand with that?
So, obviously, common question, something everybody wants to know. There's not necessarily a blanket answer to that question because each person has their own unique financial situation. Each person's going to require their own guidance. The one common theme is that most people actually don't know the difference other than saying fixed is fixed and variable can change. So I think it's important for people to understand that there's a major difference. They are tied to two completely different things. Fixed is tied to bond yields. It's important that people understand what correlates and what makes these things move. Fixed is tied to bond yields. That's how a bank offers you a loan for a fixed period of time. It correlates to bonds. A variable is tied exactly to the Bank of Canada's prime rate. And it will only fluctuate when they determine that it's time to go up or go down. And a lot of times they may just leave it alone so it doesn't move. So the variable does not fluctuate nearly as often as the fix. Fix is fluctuating. It could be, weekly. So when deciding on a fixed or variable, I work with each client to understand first and foremost, what is their financial situation? Second of all, what is the difference between the two rates? It's a relevant question to the rates at that specific point in time. Presently, the rates have had a huge gap between them. So fixed are well over 1% higher than the variable has been for quite some time now, especially during these years of the pandemic. And as a result of that delta, I've seen record amounts of people going into the variable who would have traditionally gone into the fixed. And so, if you're asking me fixed versus variable, I would say more people to date have been going into variable than they have fixed. However, the talk of the town has been that people are expecting rates to rise. Central banks are talking about raising their rates. Starting, some people are saying now, some people think it could be Q2 in Canada, and that's fine. Although I always work with each client so that it's within their comfort when they're selecting a product. And as long as they're okay understanding that with this gap, the word raising rates is not a rate. So if you're at 1.2% and they raise it by 25 basis points, you're only at 1.45%, for example, in the near future, versus somebody who was signing on to their mortgage at 2.89. So there's quite a bit of space before you even catch up to the present market's fixed. Also, what's important, at least when you were considering a variable, is that depending on the bank you go with, even if the rates go up, your payment may not rise because the payment will be fixed. And what will change is the scale in the fixed in the principal and interest within that payment. So sometimes that's an important variable when people are making a decision because they're okay with the rate of interest changing. They just really are more concerned with, in the short term, their cash flow and their payment changing. So again, there's no blanket answer. And this already is kind of a quick answer, the way I'm describing it, but it's a situation where we would assess client by client, really dig in and assess where that person is, what they're comfortable with, and what their view of the rates and the changing of the interest rates, how that feels for them.
Right. So I can wholeheartedly appreciate that, of course, no situation is exactly the same. Every client is different. Every situation really is different. But the points that you raised, I think, are pretty good. Um, what about those people that are trying to catch up with the market, that maybe got a mortgage 3 years ago, 4 years ago? a year ago, whatever it might have been, if they were looking to refinance, does that change things at all? Where are you at with that?
Yeah, so when people are refinancing, typically what does that mean? That means they're redoing their mortgage. That means they're breaking and they're moving into a new rate. That means they are potentially taking out more money. Now, if we're comparing to people who were getting into rates pre-pandemic, a couple of years ago, rates were as high as almost 4%. You were getting up to 3.8s. Some people were at 3.7, 3.8 for your 5-year fix. So during the pandemic, rates have plummeted to they're not there anymore. Rates now are in the mid to high twos, but there was a point in time where people were able to get, in the mid ones on a fixed. So that's a huge discount to their rate. And unfortunately, for example, a lot of people who worked directly with their bank is not necessarily going to tell them, hey, you should break your mortgage with us while we're making 3.7 and you should go elsewhere, and get your mortgage redone. That's kind of one of the functions of what I do. But a lot of people have been taking advantage of this lower interest rate environment to do exactly that, to either break their mortgage and move into a lower rate, in which case they're saving thousands to tens of thousands of dollars a year. Or they might even be looking at doing that and increasing their mortgage, taking out more money at a lower rate because they either want to add value to their house, maybe they want to renovate, maybe they want to invest in a new property, use that cash to use as a down payment for something else, or even just invest that cash in things like the markets or other asset classes outside of real estate that are doing much better than the rate of interest that you're paying. So refinancing has been a huge theme over these last 2 years and a tool that people have definitely been taking advantage of, to their benefit greatly.
Yeah, I mean, I've seen it so many times. I've, banked with you or whatever the terminology might be, to do such things as well. There are just a lot of instances right now where I think financially it just simply makes sense. And I'd say, maybe back to where we had started on the fixed versus variable, a lot of benefits to breaking if you were on a variable versus fixed, but not to, sort of rehash that one.
Sure.
But I've also got some other personal challenges that I think a lot of people can relate to, which is being self-employed or at least viewed that way through the bank versus those that are on payroll through their company. Do you want to speak to that?
Yeah, so it's funny because when people think about getting a mortgage, they think about one thing. They think about, I make X amount of money, of course I'm going to qualify for a mortgage. And there's nothing wrong. It's a common thought that people have, and a lot of times it's a mistake because how you are employed, your employment type is one of the most important elements that we look at and that the banks look at in terms of how they qualify you for the loan. And they are not treated the same. They are not made equally. So people who are employed by a company, it's typically a lot smoother, a little easier with them because the bank can verify an existing company. These people are obviously not the owners of it. They can look at a letter of employment and a pay stub, and they can quantify their own risk by looking at that. And typically, an employee is somebody who a bank looks at as a very steady situation. Somebody who is self-employed is looked at differently because, for one, people who are self-employed don't necessarily work for a larger company. It could be a small business, in which case a bank looks at it as theoretically higher risk because though that person's income could drastically change from one year to the next. That aside from that, people who are self-employed have the gift and curse of being able to file their own taxes and make their own deductions, and a gift in the way that they get to determine what happens and what their bottom line looks like. But a curse in the sense that the more you write off and the less you show, the banks are actually looking at your tax returns when you're self-employed, and they're going to look at your net income. So if you're someone who has a great business, call it a landscaping business that's really doing $500,000 a year, but you're writing off every living expense you could possibly think of, and you're really only showing 60, well, then the 60 is what they're looking at on your tax return that the bank is using to qualify. Now, while in reality, you clearly make great money, it's a lot harder from the bank's perspective. And another, one of my core functions is that I don't work with a bank. So I understand how all the banks function. I understand how to underwrite the deals for each bank. But in those elements, regarding those variables of self-employment, we then know how to structure your mortgage for you or how to guide a potential borrower so that they know how they're going to qualify with your typical Schedule A banks. Or if we go to an alternative lender, in our language, we call it a B lender, who's still an institution, but they might have a slightly higher rate, but they will be able to work with the person based on other things outside of their tax returns, like their bank statements, which will in fact get them the mortgage without them having to go through all the pain and anguish.
Yeah, and one thing there that I think perhaps other people sometimes would miss is just that the banks aren't really looking at one's net worth. They're very focused on income as a means of paying a mortgage in today's world.
Although, sorry to interrupt, I will say that net worth does play a part. It depends on if it's the person's owner-occupied home. So banks have net worth programs. There's just specific parameters that you have to meet, certain thresholds of liquid money that you have to have that we would have to show a history of. But yes, outside of that, it's income, income, and income.
And again, I know continuing to learn these things from you. So, part of that I think is a big element of what you do. Maybe you could also just share a little bit more about going directly to the bank versus going to you, the broker. What does that look like to you?
Right. So, and I really think that this is probably one of the most important questions, not only because it's something that I have to answer frequently to educate clients about, but it's also something that if I had to pinpoint what is the number one way that people lose the most money, it's by not knowing this. So when it comes to a difference between a bank and a broker, it's very simple. The bank is a singular business that is set up to sell their products and their products only. A lot of times banks thrive, their whole business model is where do they get their customers from? From their existing banking base. They are getting people who for some reason are giving the bank their good faith to say, hey, I have a bank account with you and my credit cards, take care of me. And the bank says, of course, we're going to give you the best service in the world, whatever you need to hear so that you work with that bank. Now, the truth of the matter is banks have structured the industry so that people are only focused on one element only, and that element is rates. Yeah. And so people don't even understand how rates affect them. So all they do is they go bank to bank to bank asking, what's your interest rate? So one bank says, I got 2.5. Okay, they go to the next bank. What are you going to give me? I'm going to give you 2.47. And they say, wow, look at me. All this hard work paid off. See, I'm smarter than everybody else. I did it myself. I got 2.47 over everybody else who told me 2.5. Now, it's really an emotional suction, I call it, because that 3 basis points, the 2.47 versus the 2.5 on $1 million loan is $300. Not a day, not a month. It's $300 for the year. That's all they save. Now, while $300 is money, it's nothing to snicker at. Savings are savings. In my line of work, that's not real savings. So you would think that whatever bank you're with, when you are with a bank and you have your mortgage with them, no matter what amount of money you have, at any point in time, that bank is never going to pick up the phone and call the client and say, hello, we're just letting you know that we heard about this other bank down the street that has this great special right now, and we crunched your numbers for you. And if you leave our bank today and you go to this other bank, you'll save 30, 40 grand over the remaining 2 or 3 years of your contract. That's not their business.
Just to sort of interject, I mean, while of course you're being somewhat facetious here, it's a strategy that I've seen you employ, with probably about 3 dozen of my clients to date. myself included even. It just makes logical sense. And if the dollars add up, I mean, of course, why wouldn't you do it, right?
Of course.
Spend less for the same amount or more. It's a home run deal, in my opinion.
Right. And that's the thing. That's the thing. It's not that if people are concerned with rate, it's because they're concerned with trying to get savings. Rate is their perception of where the savings is at. Now, while 99% of the time, I always get the client the lowest rate, where they get the value is even if they take the rate I got them and they go to their bank and their bank says, okay, Ari got you 2.5, I'll get you 2.47. That is not, like I said, where the savings is. The savings in mortgages is when you know how to manage it. So aside from guiding a client and educating them on how the mechanics of every element of the mortgage works, and then figuring out their comfort and qualifying them and educating them and make sure they're prepared to go out and purchase, that's just one element. I believe the value that I, for one, in my business bring to the table is managing their mortgage, letting them know, hey, I don't work for any of these banks. Let's get the hell out of here because this bank is going to end up losing you 20 grand over the next 2 years. And we could save that right now over here. And that is how you win in the mortgage world. It is the exact definition of time being money. And nobody wants to leave time on the table. And when you're with any bank, they're never there to tell you to leave. They're not your financial advisors. They are a business of sales, and they are only interested in selling their product. And that's what people need to learn.
From my perspective as well, with time being of the essence, I mean, I think it's really no secret that real estate obviously is not a 9 to 5 job, and it's pretty often that 11 p.m. rolls around and I'm still negotiating, some latest greatest, offer situation for my sellers or for my buyers. And yeah, I mean, I think it's amazing having somebody who's also there, in our corner who says, if it's a buyer situation, who says, yeah, hey, that $15,000 extra that's going to take to get you over the humps, that you can, acquire that property, you can do it. And that element of confidence when somebody's got, someone who's picking up their phone call instead of, you try to call TD and get someone to take your
on a
call.
Saturday night. Yeah.
It's something that is very important, because when push comes to shove, and we're at that final lap of the race or whatever it might be, it's very important to have somebody who gets it and understands that this is the business, this is the industry, and how competitive the marketplace is. And so that's another element that I think you certainly more than bring to the table. We're talking about how competitive the industry is and where things are at. And, Toronto has been so thin in terms of inventory and such a high level of competition. Where are you seeing things this coming year? What is your outlook for 2022 right now?
So I think when we talk about 2022, I think we're going to see a continuation of what we saw in 2021. The only difference being is that rates appear to be on the rise, fixed and eventually in the variable. And so what does that mean? That means that you're going to have a lot of people competing. Whoever wants to get into the market, they're going to be incentivized on both sides. If they think rates are going up, they're going to be trying to move quickly. And I think we're just going to see a lot more competition in 2022. I think we could see a tightening on inventory, which is something that we started to see in 2021. And I think we're going to see a continuation of that in 2022. I also think that there's been talks, obviously the Liberal Party talked about extending the purchasing power of people for insured mortgages. And while that hasn't happened yet, if that does happen, I think that's only going to lend itself to an even more competitive market, which is going to push real estate prices even higher. So Toronto is, I believe, going to be much of the same. And to be honest, I don't even know if it's a Toronto thing. I think that with the price increases that we've seen recently, I think that you're going to see that as an extension everywhere. I think that people are going to be looking to buy. I think they're going to have low inventory, and I think it's going to be a very competitive and hot market for 2022.
Yeah, we're definitely aligned. I mean, I think with how low inventory is, and population growth, low interest rates really only leads to one thing, which is price growth. And people, I think, are aware of that. Buyers at all levels are aware of that, and it's just the driving force of this market is people that are trying to get in or move up or go to the next property type. And so I think we're going to continue to see pretty rapid ascension in terms of prices. So yeah, it's that's where things are at. Anyways, Ari, thank you so much for your time, for your expertise, for everything that you've been able to share with us today. Really appreciate your time and everything you've shared with us.
It's my pleasure, Lani. Thanks so much for having me. Always good working with you and good being with you, even virtually, Patty.
Much love. Thank you. We'll talk to you soon. Okay.